In commodity manufacturing, profit margins can evaporate in a matter of hours due to unseen shifts in upstream costs. Navigating this kind of volatility requires moving beyond lagging indicators and securing real-time market intelligence. For the Indian subcontinent, Polymer Bazaar operates as the central node for this specific, actionable data. Their data stream reveals a highly consequential event, the Reliance Industries Limited Rate Revision Alerts, effective July 27, 2026. RIL occupies a unique position in this ecosystem. They are the dominant benchmark price setter, the entity that dictates the baseline cost of raw polymers for the domestic market. When an RIL rate revision is published, it acts as a universal floor. The entire domestic supply chain is forced to recalibrate immediately. On the surface, the July 27 alerts present a synchronized, multi-polymer upward price revision. It is easy to assume that an across-the-board hike implies a uniform macroeconomic pressure, like a sudden spike in crude oil prices trickling down. However, a granular analysis of this specific dataset reveals a deliberate, tiered pricing strategy. It is a structure designed to tax domestic margins while insulating export operations. Recognizing this underlying structural intent allows a procurement manager to shift from reactive buying to strategic forecasting. We can visualize this strategy by plotting the raw text alerts onto a chart mapping the exact price increase per kilogram against the specific polymer type. Extracting our first data point, we see PVC facing an upward revision of 4 rupees per kilogram. Next, the metrics show steep 5 rupee hikes applied to both linear low-density and standard low-density polyethylene. Finally, domestic polypropylene receives the same adjustment, hitting that 5 rupee maximum. Together, these 4 materials form the high-impact tier of the July revision. These specific polyolefins have a large volume footprint, forming the raw baseline for major domestic sectors like packaging and construction. To understand the damage, we look at unit economics. A 5 rupee jump in raw material shifts the cost structure of a single manufacturing run, directly compressing the profit margin on every finished block of plastic. This creates a critical lag time dilemma. Domestic manufacturers generally cannot pass sudden benchmark hikes onto their end consumers overnight. During that delay, the manufacturer is forced to absorb the 5 rupee hit directly out of their operational cash flow. For domestic processors reliant on this specific high-impact tier, the July 27 revision guarantees an immediate contraction of their Q3 profit margins. Returning to our chart, the remaining data points from the Polymer Bazaar alerts tell a noticeably different story. High-density polyethylene sees a comparatively lower upward revision of just 2 rupees per kilo, and the baseline data for PET shows a modest adjustment of 1.5 rupees. Comparing the two tiers directly, the price pressure placed on domestic LLDPE and polypropylene is mathematically more than double the pressure on PET. This stark spread is analytically significant because it disproves the theory that a single, universal raw material cost is driving the hike. If pure upstream feedstock costs were the sole catalyst, the percentage hikes across these base polymers would be highly proportional. Instead, the price setter is acting on supply-demand divergence, adjusting their rates based on highly localized market conditions for specific resin families. RIL is likely sensing softer domestic demand or higher inventory buffers, specifically in the PET and HDPE markets, holding them back from pushing the maximum 5 rupee penalty. Consequently, procurement teams dealing in PET and HDPE secure a temporary structural reprieve, maintaining margins that their PP-reliant competitors are losing. The pivotal intelligence in the July 27 alert is found in a specific omission. Looking closely at polypropylene, the raw data details a split categorization. The alert specifies PP deemed export, rollover, mapping a zero-change outcome directly alongside the massive domestic spike. In Indian manufacturing, a deemed export is a transaction where goods are supplied to domestic manufacturers who use those materials exclusively to produce finished items for international export. A rollover means the benchmark price from the previous cycle is extended without a single rupee of upward adjustment. This split creates a distinct pricing gap. On July 27, 2 buyers purchasing the exact same raw polypropylene from the exact same plant face a 5 rupee difference per kilo, purely based on where their finished plastic will be sold. RIL is actively absorbing upstream costs on these specific allotments to protect the margins of export-oriented Indian manufacturers. Passing a sudden 5 rupee raw material hike onto an exporter would instantly price their finished goods out of highly competitive global markets. As a result, this specific rate revision functions effectively as a structural tariff, taxing domestic consumption heavily while deliberately subsidizing the global competitiveness of export lines. The July 27 data leaves supply chain operators navigating a newly shaped landscape for the Indian polymer market. Reconnecting this tiered reality back to the initial data stream highlights the difference between reading a price and making a prediction. Supply chain leverage requires synthesizing these raw price alerts into forward-looking predictions. Domestic-focused procurement managers face an immediate imperative. They must either renegotiate downstream contracts or initiate temporary inventory drawdowns to weather the polyolefin hike. Export-focused managers, on the other hand, are handed a strategic advantage. They can leverage their protected rollover status to undercut international competitors and capture broader global market share. In the commodity plastics ecosystem, benchmark rate revisions act as targeted policy levers, realigning the architecture of manufacturing profitability.